Stop whatever you're doing for the next few minutes. What I'm about to explain is not a price move, not a rumor, and not another chart pattern. This is a structural failure inside the global silver market, and it is unfolding quietly, behind closed doors, while most investors are still just staring at spot prices on their phones. London is not functioning normally right now. The reason is simple and terrifying. The physical silver that backs the entire Western pricing system is being pulled out of circulation at a speed that the banks were never prepared to handle. Let's start with the number that should make your stomach drop. 6.9 billion ounces. That is not a typo or some clickbait exaggeration. That is the estimated amount of silver exposure tied to London-based clearing and settlement structures. When you combine LBMA unallocated balances, ETF custodial flows, bullion bank leasing programs, and all the derivatives that rely on London vault availability, that's the number you get. This isn't retail metal. This is the backbone of the entire Western metals market. And right now, large bullion banks are being forced to shift, rebalance, and in some cases, physically source metal that simply does not exist in vault form anymore. Here is the part nobody wants to say out loud. London doesn't operate on fully allocated metal. It operates on promises. Most of the silver traded through LBMA systems is unallocated, meaning customers own a claim on a pool of metal, not specific numbered bars. This system works perfectly fine as long as most people don't ask for delivery at the same time. But the moment physical demand spikes globally, the structure becomes extremely fragile. And that is exactly what is happening now. While Western investors were focused on interest rates and stock market volatility, Asia was doing something very different. China, India, and industrial buyers all across East Asia were aggressively securing physical silver. They weren't doing it for speculation, but for manufacturing survival. Solar panel factories, EV battery supply chains, semiconductor producers, defense electronics, all of them rely on silver. And when supply tightens, they don't wait for price dips. They buy first and worry about the cost later. This huge wave of industrial buying has been draining global inventories quietly for months, and London has been losing metal much faster than official reports suggest. Now, here is where JPMorgan enters the story, and this is where it stops being theoretical and becomes operational. JPMorgan is one of the largest custodians of silver in the world. It holds metal for ETFs, for industrial clients, and for interbank settlements. When physical flows start accelerating out of London and heading toward Asia, the burden of supplying that metal falls on a very small group of vault operators. And when their internal risk systems detect that available stocks are dropping below safety thresholds, action is not optional. It becomes mandatory. You see, banks don't wait for headlines to confirm there's a shortage. They monitor inventory stress in real time. They watch the delivery queues. They track bar availability by serial number. And when that stress reaches a critical level, internal directives are issued to shift metal, reduce exposure, and in some cases, prioritize certain clients over others. This isn't market drama. This is crisis logistics. When people say the London market is freezing, they don't mean trading has stopped. They mean the physical movement of metal is slowing down, settlement windows are stretching out, allocation delays are rising, and large withdrawals are no longer processed as smoothly as they used to be. This is what a liquidity crisis looks like in the physical metals world. It doesn't explode on day one. It just tightens quietly until suddenly nothing moves. Here's the uncomfortable truth. The LBMA system was never designed for sustained industrial hoarding combined with investor accumulation. It was built for a world where silver was abundant, demand was stable, and supply chains were predictable. That world no longer exists. Renewable energy mandates, electrification, defense spending, and AI hardware are all pulling on the same limited supply of metal. And unlike oil or copper, you can't just ramp up silver production quickly. Most silver is mined as a byproduct of other metals. You can't just decide to produce more of it. So what happens when supply can't respond and demand refuses to slow down? First, you get inventory depletion, then you get delivery stress, then you get internal bank controls activating, and then you get market structures that were stable for decades suddenly operating under emergency protocols. This is why you're seeing all this strange behavior. ETFs showing metal leaving their vaults, premiums in Shanghai blowing out, futures markets getting disconnected from the physical trade. And behind the scenes, bullion banks are tightening access to large physical withdrawals. All of these are symptoms of the same disease. The global silver pipeline is being drained faster than it can be refilled. Now think about this. If London loses its ability to guarantee physical settlement smoothly, what happens to global pricing? Because London isn't just a storage hub. It is the reference point for international silver trade. When that reference point weakens, price discovery shifts elsewhere. And that somewhere else is Asia, where physical demand is real, relentless, and not sensitive to price. This is the real danger for Western banks. Not that silver prices might rise, but that they lose control of price formation entirely. Once pricing authority moves to physical markets, paper contracts lose their power to suppress or stabilize price moves. At that point, the price becomes purely reactive, not managed. This is why these internal movements of large volumes of metal matter more than any daily price chart. Because once banks start repositioning physical metal this aggressively, they are preparing for something. They are not moving billions of ounces worth of exposure because they are bored. They are doing it because their risk models are flashing red. The London market is not collapsing yet, but it is no longer operating under normal conditions. And when markets leave normal conditions, they tend not to return quietly. Let Azes dive into a part of this crisis that almost nobody in mainstream finance wants to talk about, because it shatters decades of their most comfortable assumptions. The silver market is no longer being driven primarily by investors. It's being driven by manufacturers who absolutely cannot function without it, and that simple fact changes everything about how a shortage behaves. When investors buy silver, they react to price. When the price goes up, some of them sell and demand cools down. But when a factory buys silver, it's responding to a production schedule. If that factory can't get the metal it needs, it loses contracts, misses shipments, and has to shut down production lines. For them, the price is a secondary concern. Availability is everything. This creates what economists call inelastic demand. It means no matter how high the price goes, they still have to buy the metal. And this is exactly what's been happening across China's solar manufacturing regions. Panel producers are locking in their supply months in advance, paying huge premiums, and in some cases, even buying refined silver bars directly from exchanges just to melt them down and turn them into the paste they need. This completely bypasses the traditional bullion distribution system. Instead of flowing through Western vaults, silver is being absorbed locally and permanently locked into these industrial pipelines. At the same time, the electric vehicle supply chain is shifting toward technologies that use even more silver. Advanced power electronics, new charging systems, and next-generation battery designs all increase the amount of silver needed for every single car. Now, multiply that small increase by millions of vehicles, and suddenly, what looked like a minor bump in demand becomes a massive structural surge. So while Western markets are still trading silver like it's just another commodity, Asia is treating it like a strategic resource. And when strategic resources become scarce, governments and corporations don't just sit around and wait for markets to rebalance on their own. They secure supply by any means necessary. This is where the global flow of silver becomes so critical. Historically, London acted as the world's balancing reservoir. When Asia needed metal, it came from Western vaults. When Western demand picked up, metal could flow back the other way. But now, that flow has become a one-way street. Metal moves east, and it does not come back. And when that happens, vault managers in London start to see something alarming. The number of deliveries out of their vaults increases, while deposits slow down to a trickle. Their inventory starts turning over faster and faster. That's when internal controls kick in. That's when the big banks start reviewing their counterparty exposure, tightening their settlement rules, and prioritizing their existing contractual obligations over taking on any new business. This is why we're hearing reports that large bullion banks are quietly restructuring their metal positions and reallocating inventory between different custodial accounts. They're not doing this because of speculation. They're redoing it because they have to be absolutely sure they can meet their delivery obligations if clients start demanding their physical metal. Once you have too much metal promised on paper without enough physical silver to back it up, the risk of a forced cash settlement skyrockets. And that is the absolute nightmare scenario for credibility. Because the moment a major Western exchange, like the London Bullion Market Association, cannot deliver physical metal to a customer who demands it, confidence collapses. Not just in silver, but in the entire commodity settlement framework. Investors will start questioning gold, platinum, and even energy contracts. The physical markets will take over, and all those paper derivatives will become irrelevant overnight. Now, imagine this pressure building while central banks are already struggling with a fragile bond market, wild currency swings, and geopolitical instability. The metals markets are not isolated. They are a fundamental part of the collateral system that underpins global finance. If the metals markets destabilize, they will transmit that stress directly into credit markets, margin systems, and the loans banks make to each other. This is why bullion banks are so hypersensitive to these metal flows right now. They aren't just trying to protect their silver operations. They're protecting the stability of their entire balance sheet. And here is where the numbers become truly frightening. That 6.9 billion ounces of exposure we talked about doesn't a T mean there are 6.9 billion ounces of silver sitting in vaults. It means there are contractual obligations that reference the availability of silver. When the paper exposure is many times larger than the physical stock, even a small disruption can cascade into massive financial stress. Think about it this way. If only 5% of people who own unallocated or paper silver suddenly demanded physical delivery, the system would strain. If 10% demanded it, the system would break. And industrial demand doesn't care about these percentages. It simply removes physical metal from circulation, regardless of the financial consequences. This is why we're seeing all these strange disconnects in the market. Futures prices are not matching the premiums being paid for physical metal. ETFs are bleeding physical silver even when prices are rising, and delivery delays are quietly getting longer. None of this is an accident. It is the visible edge of an invisible supply crunch. And while the public sees silver trading around $30 an ounce, physical buyers in Asia are paying far, far more to secure their supply. That price gap is not sustainable. Either Western paper prices are going to have to rise sharply to meet the physical price, or the physical market will completely decouple and start operating independently. And if that happens, Western financial institutions will lose one of their key tools for managing commodity price stability. That means volatility will become the new norm, not the exception. This is why the situation today feels so different from past silver rallies. This isn't being driven by speculative mania. It's being driven by raw material necessity. And markets that are driven by necessity don't correct easily. They don't just cool off. So when you hear news about banks shifting metal, tightening vault controls, and reviewing settlement risk, you need to understand what that really means. It means the system is no longer confident in its own buffer capacity. And when the buffers disappear, shocks travel faster and hit much, much harder. The London market isn't just stressed. It is transitioning into a new operating reality, one where physical scarcity overrides financial engineering. And in that environment, all the old price models simply stop working. Here's the part of the story most investors aren't psychologically prepared for, because it forces a complete rethink of how safe, liquid, and stable precious metals markets truly are. What happens when price discovery leaves the paper exchanges and moves permanently into physical trade hubs? When that shift occurs, volatility increases dramatically. Not because the markets are broken, but because supply and demand finally meet face to face, without intermediaries smoothing out the moves. And in silver's case, that meeting point is likely far, far higher than current Western prices suggest. Remember, industrial buyers are not price traders, they are supply securers. Once they decide that silver availability is uncertain, they begin stockpiling. And when multiple industries do that at the same time, inventories disappear faster than mining output can ever replace them. At that point, the price must rise until something breaks. Either demand collapses, which is highly unlikely given global electrification mandates and defense priorities, or new supply enters the market, which simply cannot happen quickly. That leaves only one mechanism left on the table. Price must rise high enough to ration demand. This is the uncomfortable truth. Silver is entering a phase where its price is no longer a valuation metric. It becomes a rationing tool. Whoever can afford the metal gets it. Whoever cannot loses their production capability. And in that world, the banks are no longer the most powerful players. The manufacturers are. This also explains why the big bullion banks are so concerned about delivery risk. If industrial buyers decide to bypass financial markets entirely and negotiate directly with refiners and miners, the banks lose their critical role as intermediaries. That decimates their influence over pricing and liquidity. And when intermediaries lose control, markets become more volatile, not less. So, what does all of this mean for you, the investor watching from the sidelines? It means that the comfortable assumption that silver will remain liquid, easy to buy, and easy to sell at transparent prices is no longer guaranteed. Physical shortages change market behavior entirely. Premiums rise, availability shrinks, and those paper prices you see on your screen become increasingly irrelevant, like a ghost haunting the machine. We've already seen this play out in other commodity squeezes. When the nickel market exploded, exchanges literally shut down trading. When natural gas spiked, governments were forced to intervene. When energy markets break, regulators have to step in. But precious metals are different. There is no emergency production capacity you can just turn on. There is no strategic silver reserve that can be released in massive quantities to calm the market. Once physical inventories are absorbed by industry, they are gone. They are locked away inside solar panels, electric vehicles, and missile guidance systems. This is precisely why physical control matters more than any chart pattern you can draw. And it's why the movements of metal inside vault networks are far more important than daily price fluctuations on a screen. Now, let's add another layer to this: the geopolitical angle. Nations are increasingly treating critical minerals as national security assets. Export controls, strategic supply agreements, and state-supported stockpiling are becoming the new normal. Silver, essential for military electronics and critical energy infrastructure, fits squarely into that category. So even if prices rise to astonishing levels, governments may still encourage their domestic industries to secure supply, regardless of the cost. That action removes even more metal from the open markets, accelerating the shortage. And when supply chains fragment like this, global markets lose their efficiency. Prices don't move smoothly anymore. They gap up violently. volatility explodes, and the financial instruments that once tracked the physical trade begin to lag far behind the reality on the ground. This is how market fractures become permanent, and that is why the current situation matters so much. This isn't about this week's price or next month's chart. It is about the fundamental structure of how silver is bought, sold, and delivered globally. And once that structure changes, the old pricing regime cannot simply return. It's a one-way street, so when you hear reports that large banks are shifting metal, reducing their exposure, and tightening settlement protocols, understand what's really happening. They are not reacting to a temporary price spike. They are reacting to a paradigm shift. They are preparing for a world where silver is no longer abundant, no longer easily sourced, and no longer controlled by Western trading desks. And once that world fully arrives, the price becomes secondary to possession. This is the real meaning of a market freeze. It's not that trading stops, it's that trust in continuous physical availability completely disappears. And when that trust evaporates, everyone tries to secure their physical position at the exact same time. That is when moves become explosive, not because of hype or speculation, but because the simple math of supply and demand no longer allows for stability. So the question for us now is not whether silver will move. It is whether the markets will be able to adapt fast enough to prevent a completely disorderly repricing event. And history tells us that commodity markets rarely adjust smoothly when true scarcity hits. They gap, they overshoot. They create winners and losers almost overnight, and right now, all the warning signs of that phase are flashing red at once. Physical premiums are rising, vault inventories are falling, industrial demand is accelerating, and bank settlement risk is increasing. This is not a coincidence. This is a convergence of powerful forces. And once that convergence reaches critical mass, price becomes the loud and clear messenger of reality. Not speculation, not hype, reality.